After a terrible start to the year, we have climbed our way back, although over the last 12 months still stuck. What is going to be the driver of stocks going forward? It's a huge question. Let's get some answers. We've got Rich Ross and Max Wolff with us. Rich, first to you. I know you brought along a couple of different charts to where you believe, I guess, the leadership may come. Where is that?
Yeah, Brian, what's critically important here are the two sectors that I'm going to highlight today. If you want to get the market to go forward, you need some of that big market cap weighting to push that S&P ahead. It's great that energy has rallied along with materials throughout the first half of the year, but the market cap weighting for the index is very low relative to the two sectors we're going to highlight. So here's the strong finish here. Technology, your first sector. Now we know that FANG has lost some of its bite in the first half, but it's made a strong comeback here in May, Brian. It's the strongest sector in the S&P. It's up 4.5%. That's very important because it's also the biggest sector, Brian, at 20%, 1/5 of the entire index. So if tech continues to work like this, that's going to be a big help. Now, our next sector is slightly less important, but sort of equally as important in big picture, grand scheme of things. 16% of the S&P are financials. We're going to look at the BKX, the banking index. Now, this has been one of the poorer performing sectors, Brian, as interest rates have remained stubbornly low. But now what we're seeing is the specter of a rate hike in June or July is driving those interest rates higher. The dollar moves higher, and banks are responding accordingly. So if we could get technology, 20% of the S&P, and financials, another 16%, we're talking about more than a third of the S&P. And if more than a third of the S&P is working, it gives you a puncher's chance here, Brian, with skepticism still high. Positioning is very light, and market breadth is very strong. That's a powerful combination if we can get these two big sectors working in concert.
Okay, so Max, where, if anywhere, maybe it's nowhere, are you looking for leadership? Maybe there is no leadership.
Yeah, well, we do have some leadership in terms of market cap and excitement. So we see a sort of barbell trade developing, so I'd agree with that. We see value plays on folks that just have been left out of the whole post-2009 bounce. That's your financials. They're also a hedge fund favorite. And even though hedge funds are shrinking and have their issues, they're a larger portion of this lower volume market, particularly often in the summer doldrums. Likewise, tech is where everyone's been camped out for growth. That really strikes me as yesterday's news, though. So I do think it's true that tech is such a hot spot. It's growth in a low growth environment. It does have the market cap weight. We think the market's out over its skis. Having been a little bit oversold in February, we're now seriously overbought in terms of the fundamentals. Let me just give you the fundamentals as we see them. We have a rising global interest rate market. We have a threat of Brexit. We have a tumultuous summer. We have a political process in the United States that's so far off the rails you can't see them anymore. And we have a deceleration in revenue and profit growth. That doesn't usually come together after a 6-year bull run to mean it's a great time to add risk. People got a little bit over their skis selling off risk, maybe into February, but we think they've now gorged on risk and they're about to go on a summer diet to fit into that risk suit that they bought last year when they thought they'd be thinner.
So just a wild stab in the dark that you're bearish. Just a guess,
touch.
just a hunch.
I mean, I think you read me like a book. What can I say?
Yeah. Well, listen. You bring up a lot of good points, and we heard that from other people. And Rich, I'm going to go back to you though, because you gave us your leadership positions overall. But how much risk then do you see? Say, I'm going to put you on the spot here in the macro market from a technical perspective.
Yeah, well, I think Max has done a great job of highlighting some of those very well-defined, widely publicized risk factors that are out there. And I can't diminish those in any way, shape, or form, Brian. We know the world is a scary place, but all of that being said here, we have a market which is unloved, and we have positioning which is very light. And with the S&P just 2% off of an all-time high, you get the sense that we could transition quickly from sell in May into don't fight a quiet market. And if you did happen to have a technical breakout from this multi-year trading range in the S&P, it would put a lot of people to a very difficult position, either to cover shorts on a breakout to an all-time high, or people that are underweight stocks to say, how much further am I going to fall behind in terms of performance on the benchmark index? So once again, you might not want to buy. I know there's a lot of reasons not to, but underperformance is a pretty powerful motivating factor, and I think we've seen a lot of that in the first half.
Okay, good discussion there, and a very bearish Max Wolff. Max, thank you very much. We appreciate your insight. We're watching for these things, certainly as we head into the summer and nearing that Brexit vote. Rich Ross, thank you as well as always. Folks, thank you. Tune into the live version of Trading Nation on the 2 p.m. Eastern time of CNBC every day. We'll see you there. Take care.